This Week in Economics from WBRN Radio and the Bostonred.org. One of the things, if you've noticed, we've done lately, we've consolidated our shows, and most of our shows. Now you can go to Bostonred.org and you can find most of our shows. The Boston Red, which is warped into the Bostonred Network, that's our political program. It is there. The Open Source Report, that's our technological program that points to all things open source, liberate both software and hardware. And of course, Numbers Man, the one that we have here, is there also. And all of these revolve around our work either in software development or modeling as it relates to the political part, which is the Ouija board model, and we also have a slider model. And in the field of macroeconomics, we have our seesaw model. We'll get all our models straight here. And all of those are products of Cranston Analytics. We have our own analytics shop. We've had that for over 20 years now. Nonetheless, this particular program, the date on it is the 21st of October 2018. We'll be looking at home sales. We'll look at China and from their National Bureau of Statistics, what is happening in China. The Volcker rule, we'll look at it. The UK Brexit, where it is going, if anywhere, how it will affect certain sectors of the British economy. And we'll look at the markets as far as market data and also where the commodities are. All of those things have crept into macroeconomics, and our reference points are from Reuters, from Bloomberg, from the National Association of Realtors, and we have some Goldman Sachs notes here. I don't know if we'll include those on here or not. So let us move along here and get to it. Existing home sales declined across the country in September. The date line on this particular release is the 19th of October 2018. Existing home sales declined in September after a month of stagnation in August. That's according to the National Association of Realtors. All four major regions saw no gain in sales activity last month. Total existing home sales, which are complete transactions that include single-family homes, townhouses, condominiums, co-ops, fell 3.4% in August to a seasonally adjusted 5.15 million in September. Sales are now down 4.1% for year over year. That would be at 5.37 million in September of 2017. Lawrence Yang, he's the chief economist, said rising interest rates have led to a decline in sales across all regions of the country. This is the lowest existing home sales level since November of 2015. A decade's high mortgage rates are preventing consumers from making quick decisions on home purchases. All the while, affordable home listings remain low, continuing to underperform sales activity across the country. The median price for an existing home for all housing types was $258.11. That's up 4%. That's the price. Median price $258,100, up 4.2% from September 2017. In 2017 of September, it was at $247,000 and change. Price increases mark the 79th straight month of year-over-year gains. Total housing inventory at the end of September decreased from 1.91 million in August to 1.888 existing homes available for sale, and is up from 1.86 million a year ago. Unsold inventories is at 4.4 months supply at current sale pace, up from 4.3 last month and 4.2 a year ago. Properties typically stay on the market for 32 days. We'll call that 1 month in September, up from 29 days in August, but down from 34 days 1 year ago. That'd be 2017. 47% of homes sold in September were in the market less than a month. That's a very quick selling spree. There's a clear shift in the market with another month of rising inventory on a year-on-year basis. Those seasonally adjusted factors leading a third straight month of declining inventories. Homes will take longer to sell compared to a superheated, fast pace early in the year. The Realtors Market Hotness Index .com Hotness Index measures one on the market data and listing viewed per property. Revealed that the hottest market areas in September were in Midland, Texas, Fort Worth, Indiana, Odessa, Texas, in Boston, Cambridge, and Newton, Mass, and in Columbus, Ohio. According to Fannie Mae, the average commitment range of a 30-year conventional fixed mortgage increased at 4.63% in September from 4.55% in August. The average commitment rate for all of 2017 was 3.99%. That is low interest rates. Rising interest rates coupled with increased home prices are keeping first-time buyers out of the market. But consistent job gains could allow more Americans to enter the market with a ready and measurable rise in inventory. That's from Dr. Yu. First-time buyers responsible for 32% of sales in September, up from last month 31%, and a year ago it was 29% there. Profile of the buyer released buyer and seller reveals that the annual share of first-time buyers was 34%. Despite small month-over-month increases, the share of first-time buyers in the market continues to underwhelm because there are simply not enough listings in their price range. Well, that's Elizabeth Mirenthal, a sixth-generation realtor from Columbus, Missouri, and CEO of Remix Realty. Entry-level homes remain highly sought after. As prospective buyers advise to contact a realtor, contact a realtor as early in the buying process as possible in order to ensure the buyer can act fast on listings that catch their eyes. All cash sales account 21% of transactions in September, up from August and a year ago at 21%. It was 20% a year ago. Individual investors who account for many cash sales purchases purchased 13% of homes in September, unchanged from August and down from 15% a year ago. Distressed sales, that's foreclosure short sales, were 3% of sales in September, the lowest since the NAR began tracking in October of 2008, unchanged from last month, down 4% a year ago. 2% of September sales were foreclosures, 1% were short sales. Single-family co-op, condo co-op sales were a seasonally adjusted rate of 4.58 million in September, down from 4.74 million in August, or 4% below the 4.77 million share pace for a year ago. The median Existing single-family home price was $260,500 in September, up from 4.6% from 2017. Existing condo and co-op sales were recorded a record adjustment annual rate of 570,000 units in September, down 3.4% from last month and 5% from last year. The median price of a condo was $239,200 in September, which is up 1.5% from a year ago. Regional breakdown, very important here. In the Northeast, decreased to 2.9% at an annual rate of 680,000, 5.6% below a year ago. The median price in the Northeast was 286,000. That was up 4.1%. In the Midwest, existing home sales remained the same as last month, at an annual rate of 1.28 million in September, but was still down 1.5 from a year ago. The median price was 200,000. That was up 1.9% in the Midwest. In the South, decreased 5.4% to an annual rate of 2.11 million in September, down from 2.12 million a year ago. The median price in the South was 223,000, up 3% from a year ago. Existing home sales in the West fell 3.6% to an annual rate of 1.08 million in September, 12.2% below a year ago. The median price in the West was 388,500. That's up 4.1%. The National Association of Realtors is the largest trade organization with 1.3 million members. And I don't think we have here, we don't. So that is housing, a very important part of the U.S. economy. We'll go right quickly to the market. It's kind of interesting. In macroeconomics, we used to think exclusively of federal actions of the Fed, etc. Now we are looking more at the market and various other things. This is from Goldman Sachs. This is one of their notes here. It says stocks may drag on U.S. Growth. Equities have helped drive the U.S. growth as the market has surged, but that is likely to reverse soon. That's according to a forecast by the Goldman Sachs Group. The market is likely to turn from a significant contributor to a strong growth at the start of the year into a modest drag next year, barring future rebounds in equity prices, as an economist there at Goldman Sachs, Hadis, wrote. Friday, we estimate that 0.5% point boost to GNP growth from the higher equity prices at the start of the year has almost disappeared. The run-up to in the equity component in Goldman Sachs Financial Condition Index dove more than 185 basis points, erasing from the start of 2017 to late January. The index record lows, according to the report. The stock market dropped about 6% since reaching highs in mid-September. That had been the biggest factor in tightening of financial conditions since then. Most likely the case is that equities impulse to grow dropped to minus 0.25% next year. The economist said that's assuming that equity component of the financial conditions index stays about even, which is roughly consistent with forecasts by the firm's strategists for a year-on-year level of 2850 over the S&P 500. Goldman Sachs emphasized substantial uncertainty around its estimate, reflecting two-sided risk to equities themselves. Its economists outlined a bullish case, where the market would grow at 4% per quarter, taking the S&P 500 to about 3,350 by the end of 2019, where equities impulse to GMP rise at 0.25 percentage points. That also presents a bearish case in which stocks fall in additional excuse me, at 10% in Q4 and stay flat after putting the S&P around 2,500. That would be minus 0.75%. Now, this could very well happen. Let me just look at the group here. We have on a different workstation, we actually have their note, and this is, we'll come back to life expectancy. This is from Reuters. Existing home sales fall for the sixth straight month. We went over that with the National Association of Realtors. The Federal Reserve, the borrowing costs, and we'll get to that in a minute. For the third time in the year, there should be a fourth rate coming up shortly here. Economists polled by Reuters forecast existing home sales to fall to 5.3 million from a previously reported 5.34 million. Existing home sales up about 90% of U.S. home sales. There were 1.88. We've already reported this. At September's pace, it would take 4.4 months to clear the present inventory. So we've taken care of that part of it. The banks, we'll get this while we're here. This is from Reuters. Urge U.S. regulators to reconsider the Volcker rule. Tweets. Banks on Thursday pulled back on a pushback, on how regulators are attempting to simplify rules prohibiting banks from trading on their own account. A development that is likely to delay efforts to wrap up the overall in the coming months. This is on the 30th of May. U.S. regulators unveiled a plan to modify the so-called Volcker rule. This is named after Chairman Volcker, introduced following the 2007-2009 depression, aimed to make compliance easier for many firms and relieving small banks. That was the screen. Wall Street has long complained about the complexities and subjectivity of the role, which bans banks that accept U.S. taxpayers' insured deposits, such as Goldman Sachs, J.P. Morgan, and Morgan Stanley, from engaging in short-term speculative trading. The Volcker rules were introduced in 2010 on a Dodd-Frank. That's because of what happened to AIG, the insurance giant. Public comment period ended on Wednesday with several prominent industry groups, including the Financial Services Forum, the Bank Policy Institute, urging the 5 agencies involved to seriously reconsider or scrap major portions of the proposal. In particular, they say agencies should toss out a proposed new test for assessing whether trades are speculative that would focus on accounting treatment of the institutions traded. The 5 agencies of the Federal Reserve, the Office of Control of the Currency, the Securities and Exchange Commission, the Federal Deposit Insurance Corporation, the Commodities Futures Trading Commission. Reuters reported in June that banks had identified the accounting prone as a major problem that could make life far harder by capping even more trades than the current rule. Financial Services Forum, which represents the nation's largest banks, said on Thursday that the test was overboard and inconsistent and should be scrapped. The Federal Reserve declined to comment. Regulators had hoped to advance the rule change by the end of the year, but one regulation source said discussions, industry pushback would complicate, in other words. Several industry groups also pushed regulations to better streamline their supervisory work. The 5 regulators responsible for enforcement of the Volcker rule, but banks have a long complained that overseers by so many agencies could be ominous and create conflicting demands. Well, that's a situation that's a jurisdiction. Say, for instance, with credit cards, you get into the Office of Control of the Currency, the Securities and Exchange Commission. Here, the Deposit Insurance Corporation, and none of those wanted to comment, and the Commodities Future Trading Commission had nothing to say. Now, this is what Goldman Sachs said, and again, in another note here, their economists, but the firm remains, comfortable with call for 5 more interest rates, 2 more than priced in financial markets through 2019. So that 5 is 1, so it'd be 4. Basically about a replay. Notes to clients that it feels that the Federal Reserve needs to generate significant tightening in financial conditions to slow the economy to its potential growth pace sooner than later. And this will require delivering significantly more hikes than priced in the curve. Well, this is an interesting situation when you have a quote-unquote pump prime economy as what you have now. Classic Keynesian, but Keynesian economics dictates that the kind of actions that the Trump administration has done, these major tax cuts, gigantic tax cuts, etc., are done in times of economic turmoil, such as the last depression, severe recessions, etc., and not in times that are moving more to an equilibrium period. You have low redundancy or unemployment rates, at least historically. I think at 3.7. We used to consider it 2%, but we won't quibble there. But at the same time, when you have the economy growing at just a modest rate, now not at a spectacular rate, that's one of the problems. It's been advertised at a spectacular rate. That is actually not factually correct. There is some growth there. There was 1 quarter growth for 4.1%, but you can't maintain 4.1%. Period. Not across the board, quarter by quarter by quarter. So you're going to see some downturns. The retail sector has forecast an upbeat in terms of sales, more advertised than anything else, but they expect retail sales to be up. Part of the you'll see some of these retailers, because Sears and Company, basically almost the old term, bellied up. They're closing their stores right and left, making workers redundant, inventory slashing, etc., basically going out of business as quickly as possible. And some of the other retailers are picking up, quote-unquote, that slack. I was looking at some forecasts from retailers such as Target, Best Buy, Walmart. They all expect to pick up, but they're basically all chasing the same people. They're doing it digitally primarily, but they're also having pickups at the stores, etc. So the whole situation is how much cash is out there, and also how much of the so-called holiday boost. And incidentally, we're in October in the Walmarts of the world, and I was at a CVS pharmacy, and they already have the holiday Santa Claus, be it was an African type Santa Claus. But anyway, I suppose that the drum beating was coming. But these beats are already out there. Back to the consumers. Are the consumers actually charging things? Is it a credit? Is it a cash transaction for this holiday season? And what types of items are being bought? Example would be iPhone 10s or Samsung or whatever they are these days, Galaxy this. etc. Or the I don't even know what the TVs are. We don't have a TV, but anyway, 60 inch or TV sets, a 75 inch, and of course they've upgraded the types of TV sets that you have these days. A better sound, obviously, HD color, all these kinds of things. But I looked at something, how people trade in their TV sets. And it's about every 3 or 4 years to update the technology. The technology is being updated, and of course these sets are passed around or whatever. And most people, particularly people that use various cable services because of the expense, or if you're streaming videos, etc., there's a move to better types of tools. That would be your TV set or computer screens, etc. Anyway, nonetheless, we look at the car market. That used to be a big pusher. It is not now. You see the 2019 models, 2018, and some 2017s all in the same showroom. And the other big used to be multiplier home sales. You have new home sales or whatever. People would have to buy things to outfit these homes. And when they're down, you don't see the big appliances moving as much. And so those are some of the questions that you get into. That's more into micro and not macro. But you get into some of those questions there, and we'll look at that to see how our consumers are doing. Let me just check our time here before we... Oh, we're doing all right. Before we fly off to the UK, and we'll come back. We'll first go to China. I don't want to leave China short on anything. And this is national. This is from the Bureau of Statistics and national real estate development and sales in the first 9 months of 2018. The total investment in real estate development in the last 9 months was 8.886.5 billion yuan, an increase of 9.9% year over year. The growth rate decreased 0.2 points over the first 8 months of 2018, which investment in residential buildings was 6,280.6 billion yuan. That was up by 14%. The growth rate decreased by 0.1 percentage points, accounting for 7.8% of real estate development investment. In the first 9 months, real estate investment in the eastern region stood at 4 billion yuan, up by 11%, and the growth rate decreased by 0.2% over the first 8 months. The central region stood at 1.861, or at 1,861,2 billion yuan. That was up 8.4%, and growth decreased by 1.3%. In the western region, stood at 1.872.5 billion yuan. That was up 7.5%, and 0.9% in the northeast region. These are regions of China. 372.5 billion yuan, an increase of 16.5 there. So these billion yuan, actually, the way it is represented here, the first 9 months, the floor space under construction by real estate development enterprises accounted for 7,672,000 million.81 square meters, a year-on-year increase of 3.9%. Increase 0.3 percentage points over the first months in 2018. Floor space of residential building construction was 5,302 million square meters. That's up 4.9%. The floor space started this year was up 16.4%. I'll kind of simplify this by just giving out the floor space. Buildings completed stood at 511.3 million square meters. That was down 11.4%. And in the first 9 months of the land area purchased by real estate development enterprises was a total of 193.66 million square meters. That was up by 15.7 year-over-year. Growth rate was at 110% over the first 8 months of the year. Sales of commercial buildings, year-over-year increase there was 2.9%. That was down 1.1% over the first 8 months of 2018. The total floor space of residential buildings increased by 3.3%. Office buildings decreased by 9.3%, and buildings for business use decreased by 1.1%. Sales of commercial buildings increased at 13.3%. The rate of growth was down 1.2 percentage points. The sale of residential buildings went up by 15.6%. Office buildings was down 5%. Buildings for commercial business increased by 3%. So they are very detailed in what they do. Sources of funds for real estate development enterprises reached 12,188 billion yuan. That was up 7.8% year-over-year and 0.9% over the first 8 months here. Domestic loans stood at effectively 1,804.1 billion yuan. That was a decrease of 5.1%. Foreign investment stood at 4.3 billion yuan, a decrease of 61.7%. Self-rising funds stood at, we won't give you yuan, but what we will say is at 11.4. Deposits and advance payments increased by 16.3%. Mortgage loan totaled 1,772. That's 1,752.2 billion yuan. That's down 1.2%. So basically, where they are, I won't go into the rest of it here. That was real estate, where it was national real estate, industrial production in September. I think we've given this before. And what else do we have here? This is the national economy. Stayed generally stable with future economic restructuring upgrades of the third quarters here. And this is on the 19th of October. In the first 3 quarters, faced with extremely complex environment abroad and darting lack of reforms and development of home under the strong leadership of the Central Committee, Chairman Xi. The new development philosophy focused on supply-side structural reforms, embracing the requirement of high-quality development, coordinating the efforts in stabilizing growth and stimulating reform-adjusted structures, benefiting people's livelihoods and fending off risks. The agricultural production was stable and plant structures were properly adjusted. The summer crops at, let's see what we have here, 138.7 million tons, a decrease of 3.6 million tons. That's 2.2 less than last year. Production of industry and service sector was generally stable, with rapid growth of enterprise efficiency. The real growth of total value-added industrial enterprises above design size was at 6.4% year-over-year, and 0.3%, slower than in the first half of 2018. And an analysis by types of ownership shows that in 3/4, the value added of the state-holding enterprises were up 7% year-over-year. Collective enterprises down 1.4%. Shareholding enterprises up by 6.6%. And enterprise funding by foreign investors or investors from Hong Kong, Taiwan, was up by 5.7%. In terms of sectors, the value-adding of mining increased by 1.8% year-over-year. Manufacturing grew at 6.7%. And production and supply of electricity, thermal power, increased by 1.8% year-over-year. Manufacturing grew by 6.7%. And production and supply of electricity, we already went through this, grew by 10.3% in September. The value-added industry enterprise above design size at 0.3%. Specifically, information transmission software and information technology services and leasing and business grew at 37.5%. Very, very good. And 10.8% year-over-year, respectively. The September index of service products increased by 7.3% year-over-year. In the first 8 months, the total of profits registered by industry enterprises above design size were at 4,424.9 yuan. That was up 62.2% year-over-year. The profit rate of a principal business of industry enterprises above design were at 6.43% and 0.35%. It's points higher than the same period a year ago. From January to August, the business revenue service enterprise above design growth at 12% year-over-year, and the profits for service industry enterprises above the design level at 15.5%. We'll append this. It's easy to do. We won't go over everything. The consumer prices grew mildly, and growth of prices for industry products was stable. The first 3/4, the consumer prices went up 2.1% year-over-year and 1/10% higher than the first half of 2018. Grouped by commodities categories, prices for food, tobacco, and alcohol went up 1.6% year-over-year. Clothing was up 1.2%. Housing was up 2.4%. Articles and services for daily use up by 1.1%. Transportation communications up 1.7%. Education, culture, and recreation up by 2.2%. Medical services and healthcare was up by 5%. Other articles and services were up 1.1% in September. Consumer prices was up 2.5% year-over-year, and that's 0.2 higher than last month. So a little bit of inflation in there. Industrial products were up 4% year over year, and 1/10% higher than the first half of 2018. The unemployment rate dropped, and the employment situation was generally stable in September. Urban area, and this is the same as the report in the U.S., was at 4.9%, 10% less than last month. The urban survey unemployment rate in 31 major cities was 4.7%. That's effectively about 1% higher than in the U.S. The survey unemployment rate of major workforces, 25 to 59, was 4.3%, which was the same as last month. By the end, the increase of 0.9%. Now, the gap between urban and rural residents, disposable income was at 21,000 yuan, an increase of 8.8% year over year, or a real increase of 6.6% after price adjustments. The growth rate was the same as the first half of 2018. The per capita disposable income of urban households was at 29,559 yuan, an increase of 7.9% year over year, and real increase of 5.7% after price adjustment. Disposable rural households, an increase there of 8.9%, not shabby at all. The real increase was at 6.8%. That's adjusted price adjustment there. Economic statute continues to be optimized, and the economy was more consumption based. Industry continues to be upgraded in the first 3 quarters. The growth rate of value-added tertiary industry was 1.9 percentage points higher than secondary. Secondary industry accounting for 53.1% of GDP at 0.3%, 12.7 percentage points higher than a secondary industry. The role of consumption as a basic economic factor was further solidified the first 3 quarters. The contribution rate of final consumption expenditure to economic growth was 78 percentage points, 42 percentage points higher than total capital formation. Consumption expenditure on services continue to represent a large share. The third quarter of consumption expenditure accounted for 52.6% there. And I'll stop this. Capacity utilization rate was stable. The industry capacity utilization rate nationwide was 76.6%. The third quarter capacity utilization of smeltering and pressing of metals, as well as mining and washing of coats, were 78.7% and 70.1% respectively. I'm not certain on some of that, but anyway, by the end of September, the space of commercial buildings for sale had dropped 13%. More efforts were taken to improve weak links of key fields in the first 3 quarters. Investment in management of ecological protection and treatment of environmental pollution and investment in agriculture increased by 33.7% and 12% year over year, respectively, 28 percentage points and 7% faster than the total investment. New industry grew fast in the first three quarters. The value added of high-tech and equipment manufacturing increased 11.8%. So we'll just append this and we'll escape China and jump to the UK and Brexit. Firms near a point of no return. This is from the BBC. The employment group CBI said 80% of surveyed members feel Brexit uncertainty has already had a negative impact on investment decision. 150 top bosses, as they call them in the UK, chief executive of one company called the BBC PM, had done the Prime Minister, have done a good job in reassuring tone, while others said there has been nothing new in her messages. Anyway, you've surveyed 39% say they would trigger additional contingency plans if no future clarity by November, while further 19% say it's already too late. This is on the PM, the Prime Minister May. Transportation woes, they've talked about all kinds of things here. One said we haven't started charting aircraft yet, but we are looking at it. We are very worried about Dover, so we're also looking at alternative plans. So this is to avoid potential log jams at the points like Dover, flying in fresh fruits and vegetables. The UK is literally having a problem getting food in. This is one of the problems there. Car makers are looking at alternative ports, increasing warehousing and moving supply of some parts outside the UK. BMW has already brought forward an annual shutdown of mini production, coinciding with the departure from the EU. Jaguar Land Rover has warned of potential losses of tens of thousands UK jobs. And this is, we've been talking about Brexit for quite a while here, and recall on the political side covering the Brexit vote and the consequences of it, and we've talked about it here, the overall weakness of the UK economy to begin with, and without the UK it would only weaken. So in other words, what are the British getting out of Brexit? Absolutely nothing. They're going to end up in the quote-unquote red, not in the blue, or the green, or whatever you want to call it. This is the problem when you have an imperfect political solution that sounds good, but it delivers virtually nothing. And this in itself will cause implications across global markets, as we're seeing was a stronger dollar on the U.S. markets, on the U.S. economy. And tariffs, we didn't talk about them, but Brexit is sort of akin to the U.S. tariff regime, and that in itself is period. So we look at those, and let me just we'll go to who are we doing stocks from this time around. Commodities, we'll use Bloomberg. We'll use both of these services here actually, and look at the market data here. We'll just use the BBC. We'll start with the FTSE 100 plus 32 percentage points there. In Amsterdam at 0.35, it was 32.32%. In Paris, they were down 0.63. In the DAC, it was down 0.31. The Eurostasi down 0.02. In Spain, in the positive at 0.3%. The Hang Seng was at 0.42 in the positive. Nikkei down 0.56. The in Bombay, they were down 1.33%. And we'll get back to the Dow was at 0.26. The Nasdaq was down 0.43. And in Chicago, they were down. I'm assuming this is the commodities market there at 0.04 there. So Brent crude at futures at $79.78. That was up 49 cents. We don't have a spot. Hopefully we'll get it. West Texas at nothing, no change there. The Forex at $1,228.25. That's Forex for gold, and that was the EM. Well, no difference change there. See if I missed anything. No, we didn't miss anything there. And let's see. No, we gave the commodity price. The Bloomberg Commodity Index at 179.06, and the change was 0.42. The UBS was the change there was 1.82. The Reuters Jeffers 0.37. And the energy, well, we don't have a spot. I guess we'll go warning here. And basically the same thing from Bloomberg. We won't mess with platinum today. Cocoa was up $17. Cotton was down 13 cents. Live cattle, no pork bellies here, was down 40 cents. So that's about all we can get there. Not a lot out of that. Let me make sure that we didn't miss anyone. We got that right. Life expectancy, an interesting thing here. But anyway, this is from the Institute for Health Metrics and Evaluation. The U.S. The drop in the U.S. is the most of any high-income nation. Indeed, the life expectancy in the U.S. is expected to be only slightly better than that of Bangladesh, a country with lower incomes. Yet Bangladesh has made significant strides of having 6.7 more years average lifespan by 2040. The Western Hemisphere as a whole is expected to lose standing in the world life expectancy. In other areas grow at a faster pace. China, with a life expectancy there of 76.3 years, is expected to increase to 81.9 years, raising its ranking from 68 to 37. That's in 2040. China is expected to crack the top 40. Kuwait, Taiwan, and Moldova will drop out of the 40 longest living economies. In 2020, Spain, ranked fourth in 2016, is expected to take the top spot from Japan, Singapore, and Switzerland round up the above 85 club. Nigeria is expected to have the third largest population in the world. By 2050, is expected to improve its life expectancy from 158th in 2016 to 123 in 2040. The future of the world health is not preordained. That's from Dr. Foreman, Director of Data Science at the Institute for Health and Metrics and Evaluation. But we're there. The top 5 health drivers, they explain most of the future trajectory for premature mortality, high blood pressure, high body mass index, high blood sugar, tobacco use, and alcohol. Air pollution ranks 6 at the end of the month. The World Health Organization will hold its annual conference. Let me just start this off here. Americans are forecast to live 1.1 more to 79.8, while dropping to the 21st spot in the global ranking of 195 nations to 64th as the nation makes faster gains. According to the data, the U.S. drops the highest for a high-income country. So nonetheless, in 2016, it ranked 43rd with an average lifespan of 78.7 years. Let me just get down here to China. 78.7 years, whereas China in 2016 was 76.2. Not too bad. That is expected to crank into the top 40 there. From 68 to 39. So it's moving up in life. And Nigeria is expected to have the 3rd largest population in the world by 2050. And that's about 32 years up. And life expectancy from 157 ranked to 123 in 240. So Nigeria is growing and growing, and it's just gets the importance of quote-unquote generic term Africa. The population is increasing. It's increasingly younger. And if not been for various diseases, etc., that hit the continent would be in much better shape. So we've basically exhausted things here to look at to sum this up. Basically, where we stand. The U.S. economy moves on. Not much information. There have been some banking rules. Housing starts are on the water. They've continued throughout the year. We expect those not to improve, and obviously they're not going to improve at 5 over incremental, probably 2.5 basis points increase in interest rates. Moving along here, one more coming this year. So basically the real estate sector is out. Bonds are in. How the market does. A lot of how the market performs is tied to the value of some of the major components. We're looking at such things as Facebook, etc., Google, and many of those are overvalued. So you can see some adjustments happening there. Highly speculative. Commodities are going to be very interesting there. We didn't have the rig count from the GE Baker Hughes people this time around. Well, we were looking at a fracking article on fracking. That basically a lot of the fracking activity that is in the Midwest, the upper Midwest, I guess, the Dakotas, will move to Texas because of transportation costs, etc. Texas, New Mexico, primary base down there, closer to the supplies and obviously shipping there at the port of Galveston. So that will eliminate some of that. The quality is slightly better in the Midwest, but that really won't amount to as much. And where will the overall price of energy be? Well, it's going to stay high for a while. And we didn't do gasoline this week. We'll do it next week. We apologize. For those in business, make next week a productive one. And the consumer, obviously, you have entered the holiday season, which traditionally it would be around a Turkey Day, which is the end of November. Now we've started before the end of even October. And the increase in advertisement of pushing things out there, and very aggressive form of advertising. Be interesting to see where this, but that is more in the micro and not macro.